I think we're going to have a recession, by the way. And the reason I think we're going to have a recession is that we've had a money supply since March of 2022 that's declined, contracted by 4.5%. Now, this kind of contraction, we have to go back to 1929, 1933. The good thing, that might be a bad thing, but the good thing is that we anticipate inflation to be around 2% or maybe below 2% by the end of this year, the consumer price index. So inflation down, the economy probably dipping into recession later this year.
The latest U.S. inflation report showed that rising prices continue to weigh on American consumers. The Federal Reserve's preferred inflation gauge, the Personal Consumption Expenditures Price Index, was up 2.5% for the 12 months ending in February, faster than January's 2.4% rise in prices. American economist Steve Hanke anticipates a stock market downturn, a forthcoming recession, and a decline in inflation to below 2% by the year's end. In July 2021, veteran economist John Greenwood and his colleague predicted that the headline consumer price index would surge by as much as 9% annually, which peaked at 9.1% a year later. They further forecasted that this inflation measure would decrease to 2% and 5% by December of the same year, ending at 3.4%. Hanke and Greenwood predict that headline inflation will dip below the Federal Reserve's target rate of 2% by the end of this year. An article published in the National Review suggests that sustaining a 6% annual growth in M2, a comprehensive gauge of money supply, would likely maintain inflation around the 2% threshold. The U.S. money supply is shrinking the most since the Great Depression. The current M2 decline of nearly 4% is nothing compared to the money supply contraction of almost 30% that occurred during the early years of the Great Depression. However, it's close to double the decline experienced in 1921. Hanke predicts a recession based on the contraction in the money supply. He also ranks the U.S. at 132 out of 157 countries regarding the Misery Index. Let's delve into the video to gain further insights.
Misery Index, where the U.S. rank, you ran down that. Let me just look at my scoring here. I looked at 157 countries, and the U.S. is 132. That 16.7 number that you gave, that puts us in there. 132, we're close. Israel is 133. So the Misery Index score is not all that bad, and things are getting a little bit better. The inflation is coming down. Economic growth has been strong. The stock market's strong and everything. But people have a very negative view of Bidenomics and the performance of President Biden. And I think the reason for that it's twofold. One, they look in the rearview mirror and see what things were like maybe 3 years ago. And they say, well, inflation wasn't nearly as bad, and the economy was doing good, unemployment was low, everything was a little better.
And things cost 25% less.
Right. Things cost a lot less. That's one. The rear view mirror is one thing. The front windshield looking ahead is another factor. And they're looking ahead and saying, I'm worried, about some of the risks that we talked about at the opening of the show. What's going on in the geopolitical scene with 2 wars going on that the U.S. is financing, by the way. The U.S. is financing that war in Ukraine. It's also financing the one in Gaza. People say, what about a recession? Are we really going to keep riding along and sailing along smoothly? Maybe we're going to have a recession. I think we're going to have a recession, by the way. And the reason I think we're going to have a recession is that we've had a money supply since March of 2022 that's declined, contracted by 4.5%. Now, this kind of contraction, we have to go back to 1929, 1933, Adam, to find a contraction like this. And we only have 4 contractions since the Federal Reserve was established in 1913 in the United States. And every one of those has always been followed by a recession. So John Greenwood and I, using the quantity theory of money that allowed us to nail the inflation forecast when things went up to 9.1% in 2021. We use that same thing and we see a recession in the cards. And we also see, by the way, the good thing, that might be a bad thing, but the good thing is that we anticipate inflation to be around 2% or maybe below 2% by the end of this year, the consumer price index. So inflation down, the economy probably dipping into recession later this year. Because of what? The contraction in the money supply. Remember, changes in the money supply are the key to the whole thing. That's the fuel for the economy, the money supply. You got to look at the money supply.
When a tough decision looms, it helps if someone else can make it first and take the blame if it all goes wrong. It's a position much of the world's central banking fraternity has found themselves in. Almost all raised interest rates to battle inflation and are now looking for the chance to cut borrowing costs back down again. Central bankers, including Jerome Powell, have signaled that achieving 2% inflation will be bumpy. Fed officials continued to pencil in 3 rate cuts this year. Investors anticipate the first of those 3 will come in June. If inflation reaches 2% by the year's end, Hanke anticipates a significant drop in the 10-year yield, potentially resulting in a favorable capital gain. In the world's biggest bond market, there's a growing sense that the benchmark 10-year yield is set to revisit the 4.5% level last seen in November before a massive year-end rally kicked in. Now, let's redirect our attention to a video.
Interest rates follow inflation. In other words, inflation, wherever inflation goes, that leads to changes in the interest rate. So if we go out on the duration, I mean, the key interest rate is a 10-year treasury. So if you go out to the 10-year, I think that's a pretty safe bet for a trade, not necessarily an investment, not something where you take the 10-year and put it in the safety deposit box and forget about it. But as a trade, I think it will be probably a profitable trade because the interest rate will fall as inflation rate continues to fall and goes down to, I think, let's say 2% by the end of the year. If the inflation rate is at 2% at the end of the year, believe me, the 10-year yield is going to be quite a bit lower than it is now. I mean, it's up above 4%, a tad over 4%. It'll drop down, and you'll have a pretty good capital gain. So that's how you want to trade. You want to trade it, not invest in it. Is what I'm saying. The Congressional Budget Office is saying that there's a fundamental structural problem with the public finances in the United States, and either you change the structure and you cap government spending in some way, or we're going to have to increase taxes tremendously to pay for this. So one of the two. I'm for a debt break. A Swiss-style debt break. The Swiss put in a debt break. They made a constitutional change after having a referendum. And the debt break is basically says that the government spending in Switzerland can't go up any faster than the rate of real GDP growth. So
GDP growth.
So the government can't crowd out the private sector. And they must, in the intermediate period, 1, 2, 3 years, actually 2, 3, something like that, balance the budget. That's the Swiss debt break. Now, the only way you can do that in the United States is to have a constitutional amendment, and that means you have to invoke Article 5 of the Constitution, which I'm for, and having a constitutional convention to look specifically and narrowly at the fiscal situation. The idea of putting some kind of debt break in that would restructure the government's finances. It would make the structural change that you would have to control things. And if you don't do that, we're going to be in for very heavy taxes.
Federal Reserve Chair Jerome Powell on Friday reiterated a message he has sounded in recent weeks. While the Fed expects to cut interest rates this year, it won't be ready to do so until it sees more good inflation readings and is more confident that annual price increases are falling toward its 2% target. The U.S. economy has primarily defied expectations over the past year and a half, avoiding the recession many economists anticipated at the end of 2022. How does the Federal Reserve typically respond to inflation and recessionary pressures? Feel free to share your thoughts in the comments. If you found this content helpful, give it a thumbs up and remember to subscribe to stay updated. Thank you for being a part of this journey with us.